intro to DeFi, what is DeFi, and what specifically is DeFi yield farming. These slides were made back in May, so the market has changed quite a bit. Some of the slides are a little bit outdated, but I'll go over what has changed throughout the presentation. So what exactly is DeFi? So this is a tweet that Piscantis did that kind of covers everything that exists so far. And there's just a few buckets here. You have money markets, which are essentially places to borrow or lend money. So if you wanted to make some interest, you can provide capital for someone else to lend, and then you can earn interest off that. Alternatively, if you want to borrow money, like take out a loan, you can also do that. That's what a money market is. And I'll go through some examples for that later. Number two is a DEX, or a decentralized exchange. It's basically a way to swap one coin to another. The counterparty, the centralized version of the DEX would just be an exchange. So you can think of like a Coinbase or Binance. But the decentralized version would be something like Uniswap or SushiSwap, where you can actually swap tokens one to the others directly using the smart contract. And number three are stable coins. So these are things like USDT or USDC. They're basically just, a coin that people have created that tries to be stable towards one specific fiat currency. So most of them are US dollar based. Four, you had derivatives, synths, and insurance. So these are, different items like, for example, SUSD is a USD stablecoin, but it's a synthetic one where it's not actually backed by fiat currency. It's actually backed by other cryptocurrencies. Another big example would be MakerDAO and the DAI coin, DAI. So these are just coins that we've created where it's actually created only by over collateralizing or some other collateralization of assets that's not US dollar. The counterpoint to this is USDC and USDT should be backed by actual US dollars in a bank account. Number five, the other category here is aggregators or automation. So, we have a lot of different markets now where you can yield farm or different DEXs where you can swap. So people have created aggregators. So one very famous one is called 1inch. You can think of 1inch as like an Expedia for using different decentralized exchanges. It will find you the best rate, whether that's on Balancer, SushiSwap, Uniswap, things like that. There's also aggregators now for yield farming because there's so many platforms of where you can get this yield. People have created websites where just, you give the aggregator capital and it will farm for you based off of their own preferences. The largest, most well-known aggregator would be Wiren or Wi-Fi, Wiren.finance. Lastly, asset and treasury management. So there are a few products here that will help, people allocate exactly, what coins to buy and things like that. So these are just like platforms, essentially, for figuring out what to invest in. The number 7 and number 8 are just like other optional categories within DeFi. One of them is Oracle. So the most famous one is Chainlink. This comes into play because a lot of these smart contracts, they need data, specifically, for example, the price of specific coins. If you are over collateralizing to create a new coin or to provide a money market, then that money market will need to know the price of each cryptocurrency, whether that's Tether, Ethereum, or Bitcoin, and things like that. And the Oracle is a decentralized version to provide that information so that the data is not coming from one central party. And on number 8, there's a lot of gambling. People call it like Ponzi-matics, where like you invest in certain coins and get, they don't really have a purpose of then going up or going down. So those are kind of like the brief summary of like the 8 categories within DeFi right now. Now, specifically for DeFi yield farming, like what is that? That's yield farming is basically trying to generate passive income through using these DeFi smart contracts. Now, to further understand the slides later on, you probably need a basic understanding of how to use a crypto platform such as Ethereum or Binance Smart Chain, and also how to send and receive these coins using a Web3 wallet, which is like MetaMask or Wallet Connect or Coinbase Wallet. I mean, if you don't know how to use these, they're pretty easy to figure out. You just need to download it and install it as a browser extension. So a quick cover of CeFi versus DeFi. So CeFi stands for centralized finance. The caveats of this is you have to trust a centralized company. So if you're trading on Binance, you're going to have to put your money on Binance and trade there. So you trust that they won't take your money. If you're lending money to a money market such as BlockFi, that yield is going to be periodically adjusted. So for example, actually today, BlockFi just announced about 2 hours ago that they're reducing the yield. And this is just, I think due to market conditions, prices are dropping. Everyone's reducing their yield because everything's going down right now. Another caveat for CeFi is that it's restricted to certain jurisdictions. A lot of these platforms, can only work in the US, or for specific like finance, if you're a US, you cannot. If you're a US citizen, you cannot be on the platform. especially with New York citizens too. They have even more regulations with different rules and things like that. Just quick examples of what CeFi platforms would be. You can think of it as like the most traditional finance platforms, TradFi or CeFi. You have BlockFi, Celsius, Abra, Nexo, and Coinbase, and they all do different types of services, whether that's a money market lending or a decentralized trading, or sorry, centralized trading exchange. On the DeFi side, you have very things that do very, very similar um, objectives, but how they work in the back end is a little bit different. Instead of trusting in a centralized company, you have to trust the smart contract. Whatever the team that built that contract, whatever they coded, it's there for you to read, and it will do exactly as how it's coded. The yield on DeFi fluctuates basically every block or every few seconds, and it's just dependent on the supply and demand of the market. For DeFi, anyone is able to use it. Once it's launched on the specific blockchain, there's really no way to enforce or block it. You could potentially have a firewall, kind of like how China doesn't allow you to visit certain websites. But if you have a VPN or if you have certain ways to interact with that smart contract, it doesn't really restrict anyone from using it. The two main product categories within DeFi right now are lending platforms like AAVE and Compound. And again, these are similar to BlockFi or Celsius, where you can borrow or lend assets. And then the other big category is DEXs or decentralized exchanges like Curve, Uniswap, and SushiSwap. They allow you to trade one coin to another. And the example of a CeFi version of that we covered is like Coinbase or Binance. So where exactly does it yield from? Hopefully you can see some of the images here. They're a little small, but they are also a little outdated, but I'll go over how this plays into this slide. So the yield for DeFi is broken down into a few categories. You have the base APY, which could be made up of either trading fees on DEXs or lending interest on a money market, so like AAVE. So if you're providing money for someone else to take a loan, you'll be getting interest of what the person that's borrowing the money will have to pay. So if you look at the photo down below, I'm circling the third box here under USDC, and there's a few numbers here. Under the fourth column, I'm not sure if you can see, under deposit APY, it says 2.94%. What that means is if you deposit your own USDC onto this platform, you're going to be earning 2.94% interest. And on the right side, it says 3.81. That's how much somebody borrowing the asset will have to pay. So if you provide assets, you're going to be earning 2.94. And that's your basically base APY for using this lending platform. However, a lot of these platforms, they want to attract more people to use their website or to use their product. So they're providing liquidity incentives. And what you can think of this as like a little kickback, a little bonus is, if you use our platform and try it out, we're going to give you a little bonus. You can see this take place in like things like Uber or Lyft, where they offer one free ride or some kind of marketing technique to get more people to use their product. This has come to be known as liquidity incentives in DeFi, where they take a portion of their funds and use it as essentially marketing budget to attract more customers. So on the yellow boxes here highlighted in yellow, these are actually additional incentives where you get for using this specific part of the platform. So under deposit APY, you're going to get an additional 4.26% APR through their liquidity incentive, which is paid out in Matic tokens. Again, this screenshot here is actually AAVE on the Polygon sidechain. So as you can see here, you actually get 2.94% trading fees, or sorry, lending interest is the base APY, but an additional 4.26% as the liquidity incentive. The interesting thing about this snapshot is that for the borrowers, you're paying 3.81%, but after paying 3.81, you're actually getting 4.97% bonus. So here, it's actually a positive interest just to borrow money. You're essentially getting paid to borrow money for free. These rates are a little outdated. If you were to go to AAVE later, which I'll show you, these rates have dropped a lot lower, just primarily because more people have been aware of this and are trying to take advantage of this gap in arbitrage and earning money off that. Now, the screenshot below this in gray, this is a snapshot of the Curve on the Polygon sidechain. And Curve, again, is a decentralized exchange where you can swap one asset to the another. So here, this is a pool where you can swap DAI, USDC, and USDT. And you can see they have a column for base APY. Again, base APY is what I talked about earlier. For DEXs, you're not lending money, so you're not getting interest off that, but you're getting trading fees. So whenever a trader wants to swap between USDC and USDT, they will have to pay a trading fee, and that trading fee will go back to the liquidity providers. Right now, the screenshot shows a 5.26% APY for just base APY. And again, they're doing something very similar as AAVE. They're providing additional liquidity incentives. If you use this platform, they're going to give you a kickback. The kickback, as of that photo, which was like a month or two ago, was extremely high at 25% paid out in Maddox. However, this incentive has mostly ended. So it's about like 4% APY now. So it's dropped a lot since when the slide was first created. But there's still interest to be made in yield farming in DeFi. The last method is staking. So you can think of it like Ethereum has staking. Two other platforms that has example of staking would be Sushi and Aave. On Aave, if you have the actual native Aave coin, you can go to the Aave website and stake the Aave and then collect a portion of the fees that the platform generates. Similarly to Sushi Swap, if you take the Sushi, you stake it, you actually get X Sushi in return. And the people holding X Sushi will get, I believe, 0.05% or 5 basis points of all the trading fees. So that's just kind of what they call a productive asset, where if you own one of these DeFi coins, you can stake it and then generate some of the yield in return or the interest in return. So I can actually jump through a quick walkthrough. Amber, are you able to see the screen now? I'm on the Curve website. Okay, so I'm actually going to go to Polygon first. So this is what I'm going to go to Aave first. This is the lending borrowing platform. You can see the different coins here that they provide on the platform. You can deposit or withdraw, take a loan out of any of these coins that they have on this dashboard. For the purpose of this, I've actually deposited 1,000 USDC as an example. So I'm lending out 1,000 USDC, and you can see the current rate is 2.11% APY with a kickback or an extra bonus of 0.93 in paid out in Matic. I deposited this $1,000 last night, and you can see this available reward. It continues to go up. Of course, I only put in $1,000, so it's very, very slow. But whenever that number goes up, you can claim it and then take your profits back out. If you wanted to withdraw your original capital, you can also do so by just clicking withdraw and typing in how much money you want to withdraw. As you can see, I initially would put in 1,000, and I basically made 5 cents overnight. That's coming from the interest that it's generating. It actually goes straight into that pool. Now, what's interesting about Aave, again, here, I've deposited USDC, which means now I have I have collateral on the website. With collateral, you can then take a loan out. So if I wanted to borrow Ethereum, I can actually request to borrow Ethereum and borrow something like, let's just do like something like 0.1 as an example. And 0.1 will tell you the APY for how much you have to pay. You click continue. Let's see here. See what the issue is here. So I'm just going through the example of putting in $1,000 of USDC and then borrowing 0.1 ETH. And if you actually see my dashboard, let's, oops, 1 second here. You can actually see that it's updated. I've deposited $1,000. I've actually borrowed 0.1 Ethereum, which is about $185. So I've deposited a lot more money than the amount of ETH I've borrowed. But you're able to see that I actually have 0.1 ETH in my wallet now, and I can do whatever I want with it. I can pay somebody with this Ethereum. I can use it to farm other assets. And here, I'm actually paying 1.77% APY, but I'm getting 1.07% back as incentives. So this is just an example of using Aave. Now, I'm going to do something here. So what I'm going to do is I'm going to jump over to Curve. Curve is the decentralized exchange platform. This is the UI. Looks kind of funky here. But what you can see here is they have 3 different coins, DAI, USDC, and USDT. As a user, if you wanted to swap one coin to the other, you can choose, for example, USDT. You can put in like 500, and you can see that it'll, you put in 500 USDC, and if you do USDT, it'll give you 499.86 after that. And this is, basically an exchange, but it's all decentralized. So you can do this directly in the browser without really making an account, and it talks directly to your MetaMask. This is really nice because, if you were to do this on Coinbase or Binance, you have to make an account every single time. They're going to have to ask for your ID, probably your tax identification number and things like that. On DeFi, you just connect straight to MetaMask and then swap the coins. That's whatever is available to you. I'm not going to actually go through with this swap because all my money's for this example is already stuck on Aave. But if you had money on your MetaMask, you can transfer it that way. And again, you can see the current APY here. Right now, this swap is 3.07% APY with like about 4% additional base APY. So you're looking at around 7% interest if you were to provide any of these coins here per year. But again, these numbers change constantly depending on the market demand. So yeah, that's an example and walk through a curve in AAVE. One's a decentralized exchange and one's a lending platform. If we go back to the slides here, this is just a slide going over, there's a lot of other, blockchains other than Ethereum. Well, Ethereum's the most popular. There's a lot of activity going on Binance Smart Chain. There's one example called Clayton, which is the photo that I'm showing on the right. This is like a Uniswap clone called ClaySwap. There's also Polygon, which is super popular now as well. So all these different blockchains have their own lending platforms or decentralized exchanges, and every single product has their own yields. So as a farmer, a yield farmer, what you should be doing is figuring out what kind of assets you have, and then figuring out what's the best chain that you trust with your assets on, so you don't get hacked or scammed and things like that, but that you can farm with to get the most amount of a yield essentially. So the photo here is kind of a very old snapshot, but this is back when yield was crazy. It's going from 50% to over 100% APY. That's no longer the case, but you can see how a lot of people would want to tie up some of their cash to farm this yield. I'm going to quickly go over the farming aggregators. Again, I went over this before, but there's so many different blockchains and so many different products we can yield farm. These aggregators essentially just help you find the best products for you. And you can see, like, if you were to farm by yourself, gas is extremely expensive. The tweet on the right is this photo of someone trying to send coins to somebody else. It's costing over close to $100 of Ethereum just to send these coins. These new products come out all the time, so it's very hard to evaluate the risk and also, what kind of products you actually trust. So the most famous Euro aggregator is Yearn Finance, Finance. This is a screenshot on the right, and essentially what they do is they just choose a asset, for example, Ethereum or USDC. You deposit USDC to their platform, and then they will take your money and then invest it for you. They usually charge a performance fee. I think right now it's like 2 and 20, which is pretty standard, but they're going to be updating that value as yield has, kind of dropped below 2 and 20. It doesn't make sense to pay that much. But this is a pretty good product if you don't want to farm by yourself, or if you don't have enough money to farm by yourself due to gas. Now, however, this is a new slide that I added. Since around mid-May, we've seen the market drop quite a bit. Bitcoin's down about 50%. Ethereum's down close to 60% now. And what happens is, if you go back to the first slide here, the yield again comes from the base APY and the liquidity incentive. The liquidity incentive is a token that they give you. So if you're farming on Polygon products, they're going to give you Polygon or Matic coins. And if the price of the Matic coin drops, then your yield is going to drop because you're going to be getting the same amount of coins as a reward, but the price of the coin is going down. The value of that coin is going down. So what happens in the bear market is that all asset prices fall. Bitcoin falls, Ethereum will fall, Polygon or Matic will fall. And what that means is the yield will drop. So when you were getting 50% APY, you might now be getting 12% or less. Now, if you're getting 12%, that means some farmers may not think it's worth the risk anymore to put their money into the platform. BlockFi just actually announced that they're reducing Bitcoin and Ethereum yield down to like 0.25% APY. And if I'm providing money for BlockFi to borrow, and maybe it's not even worth it for me to risk my money on their platform for 0.25% a year. It's so minuscule. So people will take their money off the platform, and when people take their money off the platform, certain KPI and metrics will decrease as well. For example, a lot of analysts will say this platform has TVL or total value locked, how many daily active users, how many people are actually trading, using, and making swaps on the platform. And as people pull their money out because it's no longer worth it, then those KPI metrics will fall. And as the KPI metrics fall, then analysts may no longer buy the asset because the asset might not be value corrected anymore. So it's kind of a vicious cycle during the bear market where this will just continue to happen until eventually the market kind of finds a bottom. And however long that will take, it might be 6 months, it might be 2 years. We don't know. We might already be at the bottom. So, but this is kind of the current situation we're at now. Is asset prices are falling, yields falling, everything's going down, and metrics are going down as well. Yeah, so that's actually covers most of the slides. This last one here is basically just saying, if you see a farm with high yield, don't try to chase it by buying the coin you need to farm with. Just look at your current portfolio of what coins you want to hold long term, And let's say you're holding Ethereum, then good. Go try to find a way to earn interest off Ethereum, whether that's through BlockFi, Celsius, these centralized platforms, or DeFi on Curve and things like that. But if you see something like, like for example, Poly Whale, they had like 5,000% APY for a week. People were buying that coin because they wanted to farm with it to get the 5,000% APY. And then within a week, the price goes down 99%. Recently, the developers actually just like quit the project and disappeared. So a lot of these things, if it's too good to be true, it probably won't last that long, especially with the most recent rug pull or crash with Titan and Iron Finance. They had like something ridiculous, like 3 million or billion% APY, and eventually dropped 100%. Literally, the coin went to zero. So just, I would not buy a coin that you've never heard of just to farm the APY. Instead, you should look at what you already have and what you plan to hold long term to farm with that instead. So Amber, I guess we can jump to any specific questions here.
Yeah, I really want to thank you for your time. I think we wanted to have this recap because everyone was really interested in what you were saying during our event. And this is like more, more time with you and going over the slides again. So thank you for that. So I guess now you're really kind of suggesting that people should look into more of these centralized kind of smaller yield performers on things that you want to hold long term, and that a lot of these projects that came are kind of not going to be in existence anymore. But there still is this possibility to farm on these more centralized exchanges.
Yeah, definitely. I think there's still yield and opportunities to actually make some money, but I think it's not gonna be like this ridiculous 50% yield. Like that's not gonna stay, right? If everyone's making 50% interest a year, then like we're all gonna be rich in 5 years, like ridiculously wealthy. So I think I wouldn't be surprised if things stabilize under 10%. I think around the 5 to 10% sounds about right. But at the bottom of a bear market, then it could definitely see a little bit lower. But I'm seeing right now the most like popular farm that people are using on Ethereum is something called Convex Finance. And what Convex does is just a platform that's on top of Curve. And Curve has been around for quite a while, so they're kind of like the gold standard of farming and a decentralized exchange. And they're able to get around 10% right now. And I wouldn't be surprised if it drops down to like 5 or so, but it's still like better than holding money in your bank account. So if you were to consider either A, storing cash in a bank account, or B, buying some stable coins and farming on Curve, you have a slightly higher risk, of course, using these smart contracts, but the yield is still out there.
Interesting. So what do you think is going to be like the next kind of thing that people are going to jump onto after this whole yield thing? Yield mining and farming was such a big like trend in the last year.
Right. Yeah, it was definitely a huge trend that started probably mid last year, a little bit early last year, and that's kind of when I started as well. And it's been a very crazy 12 months or so how people have just been building incentives on top of incentives to try to lure more capital, and it's worked a lot because DeFi has grown tremendously in the past year. I think if we are headed towards a bear market, which a lot of people are starting to realize, prices are down 60%, we might have several months of just like inactivity, or the prices are just kind of getting lower and lower. People are still going to be building, so it's going to be very interesting. A lot of concepts right now is people are trying to work on derivatives. So like imagine like Robinhood, where you're buying options and things like that. People are trying to create products like that on Ethereum, which right now there's not a lot of liquidity to do derivatives and option trading. Another one is like a fixed income. So right now, all the yield on DeFi, it fluctuates every single day, right? You move some money in, it goes from 10% down to 8%, up to 15%. It's kind of crazy, and most people don't have time to track this yield. So some products are trying to figure out how do we do like tranches or fixed income, where they promise you a certain rate for a certain amount of time, and they might have different levels. So maybe like the riskier level gives you 15%, and the stable level gives you 4%. But if there are issues with the platform, you can have insurance protocols where people on the 15% or the riskier side maybe lose their money first, and then the people on the safer asset, they get less yield, but they're kind of backed by the people taking the riskier, so the riskier side first. So there are people experimenting with this as well. There's also been a lot of experimentation with algorithmic stablecoins. I'm personally not a big fan of these because from what I've seen, they've all failed, but it's still interesting to see the space grow where people are trying to create some sort of stablecoin that's not actually backed by like the US dollar, for example. So just interesting to see how people are building upon these Legos. But it's very hard to predict, what the next big thing is that will actually cause, for example, the next bull run.
So now that you have, more time on your hands, like, with the stable 5% yield, what are you going to be spending your time on? Are you going to be investing in projects or kind of building something, or what are your plans now?
Yeah, I think a little bit of everything. So I think, you can still spend quite a bit of time. Obviously, you don't need to spend as much now if you're content with whatever yield you're getting and it's not changing much. It's pretty low. But if you compare with all the big DeFi funds like Spartan Capital, Defiance Capital, these guys like Three Arrows, they all have 9-figure plus in profits from this most recent bull run. The trend that you see is that they all started in like 2018. And 2018 was basically the beginning or the bottom of the bear market last cycle. So while the general interest is fading, and if you look at like, there's a great graph on the block research. I can actually try to pull it up here. If you go to their data, and you go down to like social media, if you look at these graphs here, like let's say this is like number of Twitter followers by coin, like Ethereum, Ripple, you can clearly see that there was a peak in around May, and you can see like Twitter followers. You can see all this stuff. They have stuff over NFTs as well. So all these, you can see like the bubble is kind of ending. Um, so it's a lot of people lose interest, and a lot of people that lost money will clearly just leave the space and never come back.
Mm-hmm.
But during the bear market is where everyone actually has their head down and starts building. And if you're able to still have interest in the space, and if you have potential capital to invest in certain products, this is where you find the next AAVE or the next synthetic, so the next compound that actually goes 10,000x, right? So if you invested at the top or earlier this year, of course you might have gone some returns, but you're not going to get the crazy amount of returns where if you, for example, invested in the coin in the middle of the bear market in 2018. And that's exactly how the largest funds made so much money, is because they put a lot of capital and trust during 2018 and 2019. So that's what I want to focus my time on, is like trying to figure out what's the next most interesting product that could potentially be widely used.
Cool. Well, thank you so much, Ray. And make sure you follow Ray on his Twitter. I'm sure he's going to post a lot of more interesting things. And I hope you come back to our channel at some time.